Welcome back to the channel. So we are going to do a buy, borrow, die masterclass, a full roadmap on every aspect of this strategy. Most importantly, who is the strategy actually for? And we're going to just draw a line in the sand right here and say who can do the strategy and who cannot do the strategy. The strategy truly rewards people that are proactive in planning ahead, because the system truly punishes late reactive planning. Unfortunately, you'll find in the video that most Americans that are following traditional retail finance find themselves in a trap later on in their life, and I'm going to expose all of that in this video. And disclaimer, this video applies purely to US citizens only. It is not for Europeans or any other sector. It's going to rely fully on the IRS tax codes and tax wrappers and things like that. So straight away, if you are in the category of 0 to 100,000, you are not able to do the strategy. 90% of the concepts that I talk about on the channel, you cannot apply. For a start, the actual portfolio is likely going to just be 100% growth ETFs, growth stocks, zero margin. There's no point in using defensive stocks when there's no wealth to defend yet. There's no need for debt at all, so therefore there's not really any need for risk management. The job for you is to grow the engine, build the wealth first. And everything else in this video really just serves as a roadmap so that you don't make the wrong decision later on and you find yourself in the wrong structure. Because what's most important is people are so focused on the capital allocation, and in this video is going to talk about the capital location, which is equally as important. So you're building the engine, 100% growth, and focus on your entry valuations on whatever you're investing in. There is no magical portfolio. This channel is not really about picking stocks. I will assess businesses and assess moats and pricing power, but the channel isn't about picking a stock ticker, because that isn't the answer. It's deeper than that. It's about the psychology and the structure. If you want stock tips, you'll get them on 10,000 other channels. You can turn on CNBC or go on any social media and you'll find people trying to pitch you a stock. The strategy isn't a hack. It isn't a secret. Like, it's not some cheat code. It's about wealth preservation. It's not really about the wealth creation. So that just draws the line in the sand for that. If you're between 100k to 1 million, you are maybe starting to pour the concrete. So you're starting to put a little bit of defensive assets in the portfolio. That can be treasury bills, that can be gold, that can be defensive consumer staples, or various defensive sectors. So that when you are getting to the threshold, you can start borrowing for lifestyle. This is not like some sort of hard-coded law. This is just my opinion on the research that I've done on this extensively. Really, what I've established is normally around the $1 million to $2 million net worth, you are able to begin borrowing for lifestyle. This is normally the point where the portfolio has reached escape velocity, and you can start putting in 20% of the portfolio in more defensive assets, and we'll talk about that more. And of course, depending on your risk tolerance, you might want more defensive assets if you're happy with the position and the size of the portfolio. And as far as the actual borrowing amount, if you've watched any of my other videos, I tend to say 20%, maximum 25%. There is movement on these, of course. It also depends if your portfolio is on a Reg T account or a portfolio margin account. The portfolio margin will give you a lot more breathing room and ability to borrow more It gives you massive buying power. If you're not comfortable with that, you can still use a Reg T, but you just don't have as much of a sort of a protection, if you like, if you're borrowing more money. However, what you'll understand is the actual true defensive part of this entire strategy, the protection and risk management, is all about how much you're actually borrowing for lifestyle. Above all else, that is the defense. The defense is we're borrowing around 20% of the value of the portfolio. So what is the whole reason behind this strategy? Why is it so unique? This is vital for Americans to understand, because what you'll find is many Americans are essentially trapped. They're paper millionaires. So when you follow traditional retail advice, you will max out the 401k, max out your Roth IRA, buy real estate, emergency funds. You just follow the traditional routes. This is all great strategies. We actually use all of these strategies as well, but the one strategy that these people are missing is they're not funding a taxable brokerage account, because all of these strategies on their own, the real estate, the Roth and the 401k, they have great tax benefits at the start, but they have a fragile finishing line, and none of these qualify for the Roth and the 401k do not qualify for the step up in basis. So even if you pass these on to your children, you will just be giving them issues to deal with the tax on those. Let's just look at the 401k. The 401k, now, do we use the 401k? Of course, because it's free money. If your employer matches it, it's 100% ROI. If you have employer match contributions, you're going to take that. I'm not against a 401k, of course not. But it's just not, I wouldn't say it's a wealth building structure. My opinion is it gives survival in retirement. You can obviously, you can borrow against it, but there's a lot of friction. Okay, so look at the IRS section 72T. If you attempt to withdraw your own money before 59.5, you're hit with a 10% early withdrawal penalty. Plus the entire amount is taxed as ordinary income, which could easily push 35% plus depending on your state and federal level. So there's massive friction there. You can borrow against the 401k. It's capped at 50,000 or 50% of your vested balance, whichever is less. Worse, if you lose your job or leave the company, the loan usually becomes due immediately. If you can't pay, the IRS treats it as a taxable distribution, and it is a leash held by your employer. Just friction, lots of friction that we don't want. So we don't want to get involved in that. The Roth IRA, okay, so again, it's a retirement product, but it is excellent for after retirement because it's obviously your withdrawals will become tax-free in the end. So that is something we can certainly use as well. But it just doesn't give you liquidity between now and when you retire. Real estate is great because it's obviously your main place you live. But again, how do you borrow money against it? It's a lot of friction. Even if you want a HELOC or additional borrowing on the mortgage, you have to go through friction. You need to supply pay slips. You need to support your credit checks need to be done. It can take weeks to go through, and it requires a capital repayment 9 times out of 10, unless you have some sort of interest-only mortgage facility. But again, there's friction there, and there's restrictions there, and the actual asset itself is not outperforming the monetary supply or inflation, unless you are in a prime real estate location. But most of the time, your primary home residence does withdraw more money and requires more upkeep than actually generates you in wealth. Your emergency fund cannot be spent for lifestyle. That's for an emergency. So what you find here is most Americans can be a millionaire, but it's illiquid. So if they want to spend money for lifestyle, they can't really. They have to just use either cash or they use debt from one of these sources. Or even if they fund a taxable brokerage, what they end up doing is amputating their wealth. So they cannibalize their assets and they pay capital gains tax. So none of these strategies are ideal. Then, of course, finally, the FATCA. The IRS will follow you wherever you go. See, Americans can't just pick up and leave and go to another country and escape the tax, unlike what we can do. We can do that in the UK. We can sort of sever our ties. But IRS is you can't escape. So there is no escape. You have to play the game. And if you don't play the game correctly, you leave a lot of money on the table. Let's put it that way. So that's why the buy, borrow, die strategy is so effective. We do all of the same things that is taught in traditional finance, the 401k, the Roth, the real estate, the emergency fund, but we also fund the taxable broker. The taxable brokerage is special because of the step up in basis. So at death, though there's no capital gains applicable to your children or your heir. So this is why the strategy is so important. We plan ahead, because if you don't plan ahead, you end up getting to a position where you walk into traps. There's traps set everywhere, and if you zig when you should have zagged, you walk into either tax or a loss of net worth. Now, I've created a comparison of two people with the same starting net worth. One person chooses to sell assets and the other person does not. They use the buy, borrow, die strategy. So for example, just basic 30-year horizon with a basic 10% growth, lifestyle cash and margin, capital gains. Of course, these all depend on the individual, the state they're in and everything else. But just to get an idea, you can see the comparison between the person that sold sold their assets to spend versus the sovereign buy, borrow, die strategy. Look at the net worth comparison. The person that used buy, borrow, die had an additional $12.6 million after the 30 years. Okay, because what you have to think about is if two people here in this case study, their net worth's the same, they both need, say, 50,000 to go fund a wedding or go on a vacation or whatever it may be. Both people have to find the 50k from somewhere. So one person sells an asset, the other person uses a margin. The problem is the person used the margin, their net worth still continued to grow because they kept their assets, they kept their stocks, and they continued to grow and compound. So although the net worth stayed the exact same at the start, the buy, borrow, die strategist allowed their growth to continue. So their net worth still went up. That's the point. Whereas if you're cannibalizing and amputating your net worth, you're leaving $12.6 million on the table. That's your money that you've just destroyed, vaporized. So let's go on to accumulation. We all know about compound interest, compound growth rate. What is it we said, eighth wonder of the world or something? And it really is. And what we look at here, we're going to use the NASDAQ and this requirement. Okay, so NASDAQ, I personally like the NASDAQ 100 because it ticks almost every box that I want for the strategy to work. And I've looked at various case studies on this. The NASDAQ is not just 100 tech companies, but it's about 56% tech. And there is a little bit of defense in there. So the great thing about an ETF is you can just buy it and hold it forever. And it rebalances for you. So it takes care of itself. So if you're not comfortable buying individual stocks, you can use an ETF, a growth ETF. But I have not used the S&P 500 and I have made many videos on why. But what I'll do is I'll show you a quick example here of how the dynasties are built, the generational wealth is actually built. I mean, look here. In this example, starting off with 100k, investing $1,000 until $2 million was reached. In this example, it takes 22 years at a 10% growth, or 19 years at 12%, you see there. Okay, so this person here has saved all their way to $2 million and then just did nothing. So once they reach the 2 million, they do nothing else and they leave it for 60 years. Now, the reason I'm using 60 years is because it really emphasizes how generational wealth is built, because this is where escape velocity is reached. And as you can see here, after 60 years, it ends up at 1.7 billion on a 12% growth, or 608 million on a 10% growth. That's very conservative for the Nasdaq. The Nasdaq generally has performed around 15%. And look how much a difference just 2% growth makes. 2% ends up doubling the final net worth. And this is because 80% of the actual compound trajectory is actually in the final 20%. So it's such a slow snail pace at the start, but 80% of all the gains happen on the final 20% of the timeline. And this is very ironic because people that follow the traditional FIRE movement, they're actually selling their assets before they see the true potential. And they leave their children with whatever is left because they cannibalize the assets for lifestyle. Effectively, they're destroying millions of dollars to buy cars, clothes, watches, and vacations. And that's just not how the wealthy structure it. That's not how a family office structure it. They live entirely off of a margin loan. And as the assets just grow and grow and grow, they'll use margin to buy other assets like commercial real estate, prime real estate, farmland, gold. This is all funded potentially from this portfolio. Okay, so look at the absolute growth here. The wealth is generated. Obviously, in this example, we won't be here, but the whole point is that is the generational wealth. The children and the children's children never need to worry about money again. This is powerful. We are fulfilling our purpose and building generational wealth. You're doing something that maybe no one else before you has done. And your entire bloodline, no one has used the strategy. That's what makes this so special, because you can be the first one to change the whole bloodline. And of course, we will start to talk about obviously structuring the trust. The trust is where ideally you want to have this portfolio alongside your own one, but that's for a different video. Yeah, this is why it's so important. When you see these numbers, you start to understand. This is the important. Now, you can obviously use single stocks. Now, a very important distinction to make with single stocks. If someone, if you invested in Nvidia like 5 or 6 years ago and you're up massively on it, like 1,000% on a stock, and you want to sell it, that's, of course, you sell it, because a strong investor is what triumphs the strategy. I mean, if they're such a good investor, they're generating so much wealth, it's fine for them to pay the capital gains tax. That's just a rounding error. It's not about, it's more of a mentality first. It's a mindset before it's actually anything else. Because if you do have the mentality of, I'll just buy this and I'll sell it later, you end up just falling back into the trap of being a trader, and you've just been fished straight back in to the same strategy as everyone else. If you have the mindset of buying an asset to never sell it, you fall into the same mentality of the greatest investors of all time. So there's nothing wrong with buying a single stock, and if it runs up and you're massively successful on it, I'm not going to say never sell it. Yeah, if it's made so much money, then that's fine. There's no problem paying capital gains tax on it. But the fact is, we don't sell assets to fund lifestyle. That's the point. So if you're rotating it into an ETF, that's a wise thing to do. And the most important thing as well is we don't build the house on the sand, because you see the trap here. People spend their whole life funding, these different tax wrappers and different accounts, or they're even just on a bad platform. The strategies is all null and void potentially, because the only way we can do the strategy is if we get good, cheap access to margin. Now, if you actually look at retail platforms like Robinhood, the customer is the product. Yeah, if they don't charge anything, usually there's a fee in there somewhere, and often most brokers take fees off of spreads when you're buying and selling purchase orders, and these add up over a long-term period of time. It massively adds up. But you can see here the IBKR Pro account is on a completely different level to other brokerages, because their margin rates are almost, they almost just cannot compete with them. That's because IBKR is very strict. They run it on a strict algorithm. They won't hesitate, obviously, to margin call people that are aggressive use of speculation. But that protects us. That protects us on the platform. That gives the platform a strong, robust balance sheet, and they can have such a low cost of business. They can really charge very low interest rates, which makes the strategy possible. So you can see that I've just done a table on their various fees. They do allow one transfer a month, which is completely free of charge, and then something like $10 thereafter. So that's why I personally have chosen them. When I've compared all the hidden fees, FX spreads as well, that's important for obviously myself, but if you're only buying American companies, you might not need to worry about that as much. But we need a cheap cost of debt to make this work, because remember, our assets need to outperform our 7% hurdle of the money supply and the cost of the loan. That's why I have not chosen the S&P 500, because it cannot do that over the long period. And I've done a comparison here as well for valuation, because there obviously is a lot of fear in the market right now, and we know that because gold ran up so aggressively, and companies like Walmart is sitting with like a 50 PE ratio. That just tells me that there's a lot of fear in the market because people think there's an AI bubble. But when you just look at the pure valuation, right as today's the day of making this video, the Nasdaq 100 is actually cheaper from a valuation perspective than the S&P 500. Yeah, forward PE, from a growth perspective anyway. Yeah, just from a growth perspective. And if we compare it to the dot-com bubble, the valuation was beyond reality, of course. And people seem to forget that. There was 100 times PE ratio. It was completely overvalued because there was not even any revenue. Things like pets.com, that was truly a real bubble. That was like the tulips in the Netherlands. Whereas today, we just don't see that. Yeah, we don't see that. It's healthier. And here's something very surprising. Remember the crash in COVID, a complete black swan. Actually, the S&P 500 crashed harder than the Nasdaq. The Nasdaq crashed around 28%. Yeah. So that's interesting to look at. Usually you would think it would crash harder because people, look at the dot-com bubble, because of the 83% crash in the dot-com bubble. Terrified people, and I think people still have PTSD from that to this day. So there's the COVID crash comparison, and even if it crashed 28%, 30% today, we're not getting margin called on that at all, because it's all about the risk management. I don't necessarily care, what stocks you own, but what I care about is if they do crash 30%, is your risk management in place that you're protected from margin call? That's what this is all about. It's all about the risk management. But this is how family offices structure their wealth. top billionaires structure it, because it gets to a point where when your portfolio is large enough, borrowing 10% against the portfolio is enough to fund lifestyle. I mean, at this point, it's like, how much more money do you need? And there's so many options, but this is the roadmap. This is who this is actually for. Now, if you are someone who is in the 1 million to 2 million sector, I know for a fact you did not get to where you're at without financial discipline. The people with no money are the ones that are gambling with margin, that are using it incorrectly. I've always said before, risk is a behaviour, it's not a financial tool. So you are the person who is qualified to use a strategy. You already have financial discipline. You already know there isn't a shortcut. You already know, what it takes to build wealth. So you've already done that. Now it's about preserving it, keeping it, and building generational wealth. And that's what I'm teaching on the channel. If you are not in that category, it's just the strategy is not for you. So you won't be able to relate to a lot of the things that we talk about on the channel. But you can use it as motivation, inspiration, and a plan for the future. So there's going to be more content coming on this, going over more specifics and more details. And we're going to cover every aspect of the strategy. And we'll talk about trusts, dynasties, and other videos.